Good morning, traders and investors. Roger Scott here, senior strategist for The Trading Pub. Today is Friday. It's the 10th of November. Don't ask me where the year's gone. Actually, I'm still thinking it's February. That's where my mind is, in February. It's about 7:38 in the morning. I'm getting an early start. I have a lot of things to do today, a lot of housekeeping things. Today is going to be, the market's going to be trading on holiday time because tomorrow, or today, tomorrow, depending on where it is. If you ask 10 different people, they'll tell you two different dates. But it's the Veterans Day holiday, and a lot of hedge funds are taking the day off. So markets are, in fact, going to be muted today. So I'm going to take advantage of today's session and get some housekeeping things that Matt and I have been wanting to do for a while. So there will not be a VIP room today. And I'll post Telegram and you'll get an email, but there's not going to be a VIP room in honor of Veterans Day. And Monday we'll resume activities. I don't know if I'll be day trading today because markets are going to be very subdued. We've got a couple of reports. I'll get into all of that right now. Again, like our channel, subscribe to our YouTube channel. If you haven't subscribed to my Telegram channel, then you are truly, truly missing out. Go to rogerscott.com/Telegram and sign up right now. It doesn't cost you a penny. You could do it on your desktop, on your phone, or both. It's pretty addicting, and I do give a lot of actionable trades there. I've been on a roll there. Anyway, let's get into today's video. And again, it's Friday, so let's do a little review. Let's figure out where the market is, give you some positioning, and give you some ideas of what we can expect from the market today. So the Nasdaq is down a little bit. We had a pretty nasty down roast yesterday after Powell comments where rates may continue to go higher. I'll talk about it, but he was pretty hawkish yesterday. The Dow's doing good. The Dow's a little more defensive than the Nasdaq, but this is very random trading action. I mean, look at Nasdaq, down 50, 0.6, 79, anything below 120 or above 120 is random. And basically, if you're not 120 points on the Dow in the morning, up, or 120 points down, it's pretty random trading action. It used to be 60, 70 points, but the Dow's now at 34,000, not 15,000 or 16,000. Anyhow, not expecting a lot of upside. The bond market is starting to cool off. It's a little higher, but it fell apart yesterday after comments from the Fed. And again, 50-day moving average. We either bounce and break above or below. We're still above the 8-day EMA, so there could be some potential congestion, maybe a little consolidation today because the market will be slow. But this is not bullish for the stock market at all, at all. Speaking of the stock market, a few things we need to address. And these things are very important. First of all, volume was a little better yesterday. We got a little bit of volume, a little better than the other day. But again, nothing tremendously worth talking about and still below average. But at least we got a break in volume here. We had a nice little downside move yesterday, right off of the 100-day moving average, right off of a little bit above my resistance level. But you could see we resisted very strongly here. And this red bar means business. This bearish engulfing typically means business. And I think today, or maybe on Monday, we're going to break the 50-day to the downside. We may try to rally today, but honestly, I don't think the market's going to have too much juice today. So I would be much more inclined to look to the downside, especially with bond yield higher and Fed comments and the trajectory that we're in right now. But the fact is, if this breaks and if the S&P breaks and goes back to 432.80, which is only about a point away from where it is right now, it's not going to, or a point and a half, it's not going to be pretty. This trading action made it very, well, these 4 days made it very hard to day trade. This yesterday made it pretty, not bad. It was easier. But again, it hasn't been the greatest market. And again, volume has been low. And even yesterday on a big down day like this, volume was lower than average, which was why today, unless something drastic happens, I'm not expecting the market to show very, very strong volume. Now, looking at the QQQ, you could see that we're still holding on. We're still above the 100-day moving average, but this line that I drew here, look at all of the congestion here. Look at the price action here. We have to get above this level here. How are we going to do that? There's no catalyst. There's no earnings right now. There's absolutely nothing except the Fed staring us in the eyes and holidays coming up. Now, we do have seasonality, but again, it doesn't have to start now. It could start in 2-3 weeks from now. So I'm not expecting us to drop all the way down, but I am expecting a little bit more downside, maybe to the 50-day line, maybe down here to the 360, and then more upside, because it is a seasonally bullish period. But I'm just not feeling it right now, especially on a Friday, a holiday. Volume was okay on the Nasdaq yesterday, still below the average or right above, like slightly at the average. But again, not expecting anything really, really hyper bullish from the market. And after these type of run-ups, this is like a run-up we haven't seen in 2 years. You usually have a couple of down days, a couple of sideways days for the market to balance out before gaining strength. So we could be seeing that. So I'm not expecting a major down move all the way down, but I'm not expecting a major move up either. We may just kind of consolidate around here. I would actually prefer us to break down, because the faster we break down, we'll start going up again for the December seasonality. But as of right now, I'm just not feeling it, and I'm not seeing it. Let's talk a little bit about the economy overall, and we'll talk about why the market did what it did yesterday, and then we'll talk about sectors. So the benchmark closed lower on Thursday as hawkish remarks from Federal Reserve tempered optimism regarding a peak in interest rates. Folks, I'm going to tell you right now, they are in a sit and wait mode right now. They're not looking to do anything, not because they think interest rates have peaked or not. They just don't know. They just don't know, and they're not going to say, hey, we just don't know what's going to happen. So they're trying to do everything possible to buy time. And really, that's all they're doing right now, buying time. Read between the lines. Labor Department reported jobless claims yesterday. It was 217,000. This is absolutely no impact on the market because it's been in the low 200,000s for a while. Now, here's where we get to the good stuff. He assured on Thursday that the central bank would not hesitate to implement further policy tightening if inflation remains high and economic growth continues to be robust. And so far, they have. Right here, look, jobless claims. Powell acknowledged the deceleration in price growth in recent months, saying that the Fed was gratified by this progress. But he emphasized Fed officials are uncertain whether current monetary policy is sufficiently restrictive to bring inflation back to 2%. We are not confident that we can achieve a stance. The truth is, the funny thing is, I think for the first time in his life, I'm going to say it, he's actually just being totally honest with you. He was being very squirrely when he was being defensive, when he was in error by not taking any action for too long. So he was playing defensive. But right now, it just is what it is. He's being 100% honest with you. They don't know. Now, he's not going to tell you, we just don't have any idea. What he's saying is, we'll see what happens. And it's true. Barkin stated that although there's been real progress, it remains uncertain whether U.S. central banks will need to raise rates further to finish its job. And Bostic said monetary policy was likely sufficiently restrictive. They just don't know. And obviously they're going to say, I just don't know. I just don't know. But that's where they're at. They just don't have a clue. And that's where it is. And we have to just accept that. There is a 19% chance that the Fed is going to raise rates in January, only a 9% chance they're going to do it in December. I personally think that there's a 0 chance they're going to do it in December. They're going to wait and see. They want to see if this market has some legs to move. They are supposed to be completely market neutral. Do you really think they're market neutral? I'll bet you that Powell invests in stocks like anyways. We got the consumer sentiment. Remember, it's happening at 10 a.m. So if you're a day trader or if you're a swing trader, you probably want to unload positions before that announcement if you have a good profit, but you don't want to initiate any positions between a major report. And this is a major report, and it could cause a bump. So be careful and don't take action until after this report at 10 a.m. Europe. We're not getting any tailwind from Europe. They've got losses after Jerome Powell opened his mouth, but he was being totally honest. I'm hard on him. He's just totally being honest with you. That's just where they're at right now. Material and real estate stocks are leading the market lower. That makes sense. Interest rates are not good for basic materials or real estate. China closed lower. No tailwind from China today, as sentiment towards the country remained weak amid disappointing economic readings. Car stocks declined on Friday. Car stocks haven't been doing well here either. And Tesla's starting to follow GM and Ford. Although it's in a whole different category, it really isn't anymore because a lot of those other companies are doing EV stocks like Ford and GM. So they're not as separate as they were. They're not as elite as they were 10 years ago. Nikkei closed lower. We're not getting any tailwind from Japan, from China, or from Europe. Look at this. Down, lower, lower as investors digested hawkish remarks from Jerome Powell. Healthcare stocks lost. They lost big yesterday here, too. We were taking advantage of it like rascals yesterday in the day trading room on AbbVie. Consumer cyclicals, technology, these are all stocks that are interest rate sensitive. And we may see more of that today after consumer report comes out. So what are we looking at right now? Well, let's take a look at our ETFs and let's see how sectors are looking. Now, remember yesterday, I told you that over the last week, tech was strong. Well, still is. Semiconductors, technology, QQQ, communication, we're back on top. Everything technology in the last 5 days has been rocking and rolling. Home builders, financial, consumer discretion is down here. Energy, utilities, and retail. Retail consumer sentiment report comes out today. Russell 2000. I told Matt to short this thing. Basic materials, healthcare, consumer staples, blue chips. But let's move back 3 weeks. Technology. Let's go back 6 weeks. Technology. It looks like tech still wants to lead. And if you look at the QQQ, it's holding up a lot better. I mean, look at the Russell right now. Oy vey. Wrong ticker symbol. Sorry. Look at this thing. Does this thing look like it wants to go up? This thing looks like it wants to hit the bottom again. Oh yeah, it's like that. I may want to short this today. Right below the 8-day, below all the averages, volume is good. I may want to short this today. So if I was a betting man, I would bet on the Russell 2000 coming down. I'll give you some options. I know you guys like options. Let's go back. No, not 5 days. Let's go 7 days, all right? Right here, 168. 168, maybe 169, 168. Go right here. If nothing happens by end of day today, if we don't break this low by the end of today, probably what you want to wait for is you want us to break this low. Wait for us to break this low and then wait for a little pullback to the upside. That's when you want to buy the option. As far as sectors that I'm looking at right now, tech has made a new high and then swung back down. Be careful. Be careful with tech right now. Be really careful with tech. Everything looks bearish. I mean, look at this. Everything looks like it's pointing down. So honestly, I'm expecting downside. I'm expecting more downside in the market. Maybe not extreme, but I'm definitely expecting downside. And I don't like the small caps. And usually the small caps are the first one to take a dump when we have a down spiral. Now, folks, it's not often I learn something new about trading. Well, I learn something new all the time, actually, but nothing surprising. I've seen it all. But this week, I had the pleasure of hearing about a pre-market trading strategy from arguably the world's #1 pre-market expert. It's based on a candlestick pattern that flashes at 7 a.m. Eastern time. A pattern that often precedes the market's most aggressive daily moves. And you know how much I love candlesticks. Look at this. All I think about is candlesticks, right? Can't make that up if you tried. It's a pattern that often precedes big, aggressive daily moves. Now, I understand it sounds a little wacky, but this same candlestick pattern tipped this expert off to a dot-com crash and even the great financial crisis. And this week, he's promising to teach it to a handful of traders, and it's supposed to be very, very cool. Don't miss out. You want to check it out. Follow the link below. Check it out. It's going to be a lot of fun. And remember, no VIP room today. All right? I'll see you guys later. Bye. Have a great day. Feel free to email me, roger@rogerscott.com. Post comments below this video and have a great weekend. And remember, the markets are fairly bearish right now, sentiment-wise.